March 27th, 1980, a Thursday morning. Two billionaire brothers walk into their broker's office. They owe $100 million. They don't have it. And within hours, the entire US financial system is on the verge of collapse. The price of silver crashes 50% in a single day. Banks scramble. Wall Street panics, and the Federal Reserve has to orchestrate an emergency bailout of over $1 billion to prevent a total meltdown. This actually happened. And here's the crazy part. It all started because of one metal, one price level, and one massive bet that went catastrophically wrong. Today, we're diving into the story of Silver Thursday, the Hunt brothers, and how a key price trigger nearly destroyed the banking system. And trust me, what you're about to discover is more insane than any financial thriller Hollywood could dream up. Let's rewind to 1973. Nelson Bunker Hunt and William Herbert Hunt, two brothers from Texas, sons of the legendary oil tycoon H.L. Hunt, who was once the richest man in the world. These guys weren't just wealthy, they were billionaire-level rich with a capital R. But here's the thing, they were terrified of inflation, terrified that the US dollar was going to become worthless. And they wanted protection. Now, normally people turn to gold, right? But there was a problem. Since 1933, it had been illegal for US citizens to own gold. Franklin Roosevelt had banned it during the Great Depression. So the Hunt brothers looked at the next best thing, silver. And in 1973, silver was trading at just $1.50 per ounce. Cheap, accessible, and they were convinced it was undervalued. So they started buying, not just a little bit. They bought physical silver by the millions of ounces and stored it in warehouses. But physical wasn't enough. They turned to futures contracts, financial instruments that let them control even more silver without actually having to pay for it all up front. By borrowing heavily from banks and brokers, they leveraged their position. And here's where it gets wild. They didn't just settle these contracts in cash like most traders. They demanded physical delivery. They actually took the silver. This created a supply crunch. Think about it. If someone's buying up all the silver and actually taking possession of it, there's less available for everyone else. And when supply drops, what happens to price? It explodes. Between 1979 and January 1980, the price of silver went absolutely parabolic, from $6 per ounce to $49.45. That's a 713% increase in just over a year. On January 18th, 1980, silver hit its all-time high of nearly $50 per ounce. Gold also peaked that day at $850. The Hunt brothers were sitting on billions of dollars in paper profits. But here's what made this so dangerous. They didn't just own silver. They controlled an estimated 100 million ounces of physical silver and another 90 million ounces through futures contracts. That meant they held roughly 1/3 of the entire world's privately owned silver supply. Think about that for a second. Two individuals controlling 1/3 of a global commodity. The markets were going insane. People were raiding their homes for spare silver, melting down silverware, selling jewelry, anything to cash in on these sky-high prices. Industries that relied on silver like photography and electronics were getting crushed by skyrocketing costs. And then Tiffany & Company took out a full-page ad in the New York Times on March 26, 1980. The ad condemned the Hunt brothers, calling it unconscionable for anyone to hoard several $billion worth of silver and drive prices artificially high. But by then, the regulators had already moved. On January 7, 1980, the COMEX Exchange in New York introduced Silver Rule 7. This was a game changer. The rule placed massive restrictions on buying silver futures on margin, meaning you couldn't use borrowed money to buy anymore. You had to put up 100% cash. The Hunt brothers, who had been leveraging billions of dollars in borrowed money, were suddenly cut off. At the same time, the Federal Reserve was raising interest rates aggressively to fight inflation. Between January 1979 and February 1980, the Fed hiked rates from 10% to 14%. Borrowing became expensive, credit dried up, and the Hunt brothers' buying power evaporated overnight. Silver prices started falling. Slowly at first, then faster. And here's where leverage becomes a killer. When you buy on margin and prices drop, you get margin calls. Your broker demands more money to cover potential losses. The Hunt brothers started getting hit with margin call after margin call. At first, they could handle it. They borrowed more. They liquidated assets, but the calls kept coming. And then came Silver Thursday. March 27, 1980, the Hunt brothers missed a $100 million margin call to their broker, Bache Halsey Stewart Shields. The news hit the markets like a bomb. Confidence evaporated. Panic selling ensued. Silver prices plummeted from around $21 per ounce to $10.80 in a single day, a 50% crash in hours. But it wasn't just about silver anymore. The Hunt brothers had borrowed over $6 billion from more than 20 banks and brokerage firms. If they defaulted, those institutions were going down with them. And we're talking about major Wall Street players here. This wasn't some isolated incident. This was systemic risk, a potential domino effect that could trigger a banking crisis reminiscent of the Great Depression. The Hunt brothers were facing a potential $1.7 billion loss. At that moment, they became the greatest debtors in financial history. Banks and brokers were staring at catastrophic losses. Stock markets were tumbling. The entire financial system was teetering on the edge. Federal Reserve Chairman Paul Volcker watched this unfold and realized the gravity of the situation. If the Hunts went under, they could take down multiple financial institutions with them. This could punch a hole in the financial fabric of the United States, as he later described it. Harper's Magazine would later call Silver Thursday the first great panic since October 1929. So what did they do? An emergency rescue. A consortium of U.S. banks, with the blessing of the Federal Reserve, assembled a $1.1 billion line of credit for the Hunt brothers. This wasn't a government bailout, at least not officially, but the Fed's involvement made it clear. This was about saving the system, not the brothers. The credit line allowed the Hunts to meet their immediate obligations and prevented their brokers from collapsing. It stabilized the markets temporarily, but for the Hunt brothers, it was the beginning of the end. They spent the next 8 years selling off assets to repay debts. Oil fields, ranches, art collections, everything went on the auction block. In 1988, a federal jury found them guilty of conspiring to corner the silver market. They were ordered to pay $134 million in damages to a Peruvian mineral company that had lost money because of their manipulation. Both Nelson Bunker Hunt and William Herbert Hunt declared bankruptcy. Nelson, who had once been worth $16 billion, emerged with less than $10 million. Still rich by most standards, but a fraction of what he'd had. But here's what's fascinating. The Hunt brothers always denied they were trying to manipulate the market. They claimed they were simply hedging against inflation, protecting their wealth from a collapsing dollar. And you know what? There's some truth to that. Their decision to take physical delivery of silver supports this argument. If you're just speculating, you settle in cash. If you're worried about the dollar, you want the real metal. But regardless of intent, the impact was undeniable. They created a bubble, and when it burst, it nearly destroyed the financial system. The aftermath led to major regulatory reforms. The Commodity Futures Trading Commission strengthened oversight of commodity markets. Position limits were introduced to prevent any single entity from accumulating too much of a commodity. The rules were rewritten to make sure Silver Thursday could never happen again, or could it? Fast forward to today, silver is trading around $48 per ounce as of December 2025, closing in on that historic $50 level from 1980. And once again, there are warnings about systemic risk in the silver market. But this time, it's not about two brothers. It's about something much bigger, the disconnect between paper silver and physical silver. Here's the issue. There's way more paper silver, futures contracts, ETFs, derivatives than there is actual physical silver available for delivery. Estimates suggest that bullion banks hold massive short positions in silver, betting that prices will go down. Reports indicate that for every dollar silver rises, certain banks could lose $150 million, or in extreme scenarios, even more when factoring in derivative exposures. In late 2024, 5 U.S. banks were reportedly $1.3 billion underwater on short positions covering nearly 708 million ounces of silver. So what does this mean for the average person? It means we're potentially standing at the edge of another systemic event. The $50 silver trigger isn't just about price, it's about what that price reveals. Massive short positions, supply deficits, a disconnect between paper and physical, and banks that might not be able to deliver what they've promised. The Hunt brothers showed us what happens when leverage, speculation, and a concentrated position collide. Silver Thursday was a warning. The question is, did we learn from it, or are we about to repeat history on an even grander scale? Only this time, it won't be two brothers causing the crisis. It'll be an entire system built on promises it might not be able to keep.